Howdy, y'all. Welcome to Liberty Call. Today is Wednesday, October 4th, 2023. Hope everybody's having a fantastical day out there. I am Raymond Dahlman, your humble host here at DSA Financial Group and the Liberty Call program. Looks like a much better day, at least to finish off the market. It was in the red most of the day, but looks like some buyers jumped in at the last minute and pushed the markets back into the green for today. So for today, things seem all right. All righty. But if you go to my Facebook channel, you can go watch. I did a financial bootcamp class earlier today. No one was watching. It was just kind of my first run through. But you're welcome to go there and watch through it. See if you pick up anything or send me some ideas about things to talk about. I am always open to that. So, all righty. Well, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, yes, you in the black shirt and the yellow shirt behind him. Press the like button. Give me some thumbs up, likes, shares, subscribes, follows. Press that notification bell because you want to know when I go live. All right. Here we are. All right. Let's get into the numbers for today. The Dow Jones was up 0.39%, 127 points, closed at 33,129. S&P 500 up 0.81%, closed at 4263. NASDAQ up 1.35%. Closed at 13,236. VIX was down 6.07% today. It's at 1858. Canada up 0.07. Brazil up 0.17. And Mexico up 0.79. Over in Europe, Germany was up 0.1%. The UK was down 0.77. France was flat at 0. Netherlands up 0.17, Spain down 0.68, Italy down 0.17, Switzerland down 0.07, and Portugal down 1.26%. In Russia, both exchanges were red. MOEX down 0.31, RTSI down 0.24. And Asian markets, those that are open, the Nikkei in Japan was down 2.17%. Australia was down 0.77%. New Zealand up 0.07%. All these are closed still. The Hang Seng was open. It was down 0.52. The Taiwan weighted was down 1.1% for the day. All right. So not quite as good in the overnights and European markets, but somebody got happy here at the late part of the day and pushed things up into the green. So. All right, let's get to the market recap for today. The S&P 500 jumps as slowest private job gains in 32 months halts surge in U.S. yields. Let's see what they have to say there. All right, so on Wednesday, the S&P 500 experienced a positive trajectory, partly attributed to a halt in the surge of Treasury yields. The shift in the bond market was influenced by a report revealing a significant slowdown in private job growth, alleviating concerns that the Federal Reserve might hasten an interest rate hike by the end of the year. Oh, God. If the Fed goes up to 5 3/4, what will we ever do? All right. According to the latest ADP and Moody's Analytics report, private payrolls expanded by 89,000 in September, marking a notable drop from the 180,000 recorded in August. This figure fell short of economists' predictions of 153,000, representing the slowest growth pace since January of 21. The deceleration in job gains in the past months hints at loosening in the labor market, contrasting with Tuesday's data indicating unexpected strength in labor demand. So we got one report says good, one report says bad, and everybody takes those ones that just give them what they want to see and go, oh, see, the Fed's not going to raise rates. Neela Richardson, the chief economist at ADP, pointed out that the reduced private job gains coincided with a steady decline in wages in the past 12 months, and that was in quotes. This data contributed to a temporary reprieve in the surge in Treasury yields, with easing expectations that the Federal Reserve might be compelled to raise rates in November. The tech sector experienced renewed demand as Treasury yields stabilized, with notable gains in companies like Alphabet, Class A, and Microsoft Corporation. Intel saw an uptick following its announcement of plans to separate its programmable chip business into a standalone entity, potentially paving the way for an initial public offering in the next 2 to 3 years. In contrast, energy stocks did not partake in the overall market rally as oil prices slumped over 5%. This decline followed the decision by OPEC and its allies, OPEC Plus, to maintain existing production levels. Key players in the energy sector, such as Marathon Oil, Devon Energy, and Schlumberger, witnessed substantial declines due to falling oil prices. The decision by OPEC Plus to keep production unchanged was largely anticipated. Saudi Arabia and Russia reinforced their commitment to ongoing supply cuts through the end of this year, aiming to counterbalance diminishing demand diminishing demand growth and provide support to oil prices. S&P Global emphasized the importance for OPEC Plus leaders to remain dedicated to supply restraint to maintain low oil inventories and elevated prices. So if you're wondering why gas is still expensive, part of it is that the Saudis and the Russians and basically everyone OPEC Plus have decided to, and this goes back a few months, to reduce how much they're pumping out of the ground. Well, when there's less that comes out of the ground, there's less crude oil to refine into distillates, gasoline, all sorts of things, your diesels. And, so if there's less crude oil to turn into energy, then that makes energy more expensive. So that's the problem. We're pumping at, massive capacity here domestically, even though the oil rigs are still down by 100 from where we started the pandemic 3 years ago. But, oil coming out of the ground right now, if you look at the U.S. numbers, is about on par with where we were 3 or 4 years ago. So I don't know. Are they doing more with less? I mean, and plus what's going on from the overseas markets. I mean, it's just making things more expensive. All right, let's jump over to our next article here. U.S. service sector growth slows moderately. In September, the U.S. services sector displayed a slowdown in new orders, reached a 9-month low, according to the ISM Institute for Supply Management. Despite the moderation, the pace remained consistent with expectations for solid economic growth in the third quarter. The ISM's non-manufacturing PMI slipped to 54.5 in August, from 54.5 in August to 53.6 in September, in line with economists' expectations. A reading above 50 indicates growth in the services industry, which constitutes more than 2/3 of the U.S. economy. The moderation in private job gains, with payrolls growing by 89,000 in September compared to 180 in August, suggests a gradual slowdown in employment. Nevertheless, the overall resilience of the economy, even after 18 months of interest rate hikes by the Federal Reserve, indicates that monetary policy might continue to be tight. And I mean, interest rates were up around, or inflation was up around 10%. And I mean, they only got it up to 5.5. So, I mean, if you look back historically, they had to raise rates up to or above the inflation at the time. And we just have to look back at the early 80s to see the most recent time where we went through this situation. And my fear is that, they're going to either pause or start ratcheting down the rates. And then we're going to start to see inflation really start to creep back, especially if the energy does not continue to subside, which the Saudis aren't helping with. Which, again, I don't blame them. America treats them like dirt. So, especially with the Russians, if I was Russia, I wouldn't do anything to help America. All right, where were we? Despite the decrease in new orders to a level not seen in December, order backlogs improved and exports increased. The report revealed that 13 industries reported growth, including retail, trade, mining, utilities, construction, and public administration, while 5 industries, including accommodation and food services and wholesale trade, reported a decline. The survey indicated that prices remained elevated, with 12 services industries reporting an increase in prices paid. Inflation in the services sector stayed persistently high, with the prices paid measure at 58.9, unchanged from the previous month. The employment gauge for the services sector dipped slightly to 53.4 from 54.7 in August, reflecting supply issues. The U.S. Central Bank has increased its policy rate by 525 basis points since March of last year. Despite higher borrowing costs, the demand for labor remains robust, while the ADP National Employment Report showed a smaller than expected increase in private payrolls. Some economists cautioned against relying too heavily on this data, citing a historically negative correlation with the Bureau of Labor Statistics' more comprehensive employment report. The U.S. government is set to release the September employment report later this week. So we shall see what happens there. It may be good, maybe bad. All right, some more on oil. Oil is down 6% in biggest loss of the year. Gasoline build hijacks the OPEC show. All right, crude oil prices experienced a nearly 6% decline, marking the most substantial one-day sell-off since September of last year. This sharp drop followed a rally since June, primarily fueled by OPEC's production maneuvers, creating concerns about short supply. However, this rally lost its footing amid growing fears about the global economy, especially in Europe. The resilience of the U.S. economy contrasts with concerns about inflation driven by energy prices and has led the Federal Reserve to maintain a hawkish stance on interest rates, resulting in a stronger dollar. Yeah, it's doing real well this week. The seasonal slide in U.S. demand, often overlooked during the recent oil rally, also contributed to the drop. Additionally, an inventory report from the U.S. government revealed a significant increase in gasoline stockpiles, the largest weekly build since January of last year. This comes as demand for fuel typically softens in the U.S. during this time of year. OPEC's meeting, while reaffirming its commitment to production cuts, was overshadowed by the broader economic concerns. The build in U.S. gasoline stockpiles and the unexpected rise in crude volumes at the Cushing hub, despite high demand for U.S. crude, contributed to the downward pressure for oil prices. So it's a little bit. I mean, we were down in the 70s just a few months back, which that was awesome. I was hoping we'd get down into the 60s. And, while that doesn't help my oil investments, it does help how much, driving my big old truck and everything else and everyone else out there. So I'm a little selfish. All right, last up, it's an article here from Mises Wire, the House Showdown, Separating Truth from Outright Falsehoods, written by Connor O'Keefe. So let's see what he had to say. All right, Representative Kevin McCarthy was ousted, was removed as Speaker of the House in a contentious turn of events, reflecting a standoff with Representative Matt Gaetz. The dispute originates from a concession McCarthy made in January to secure votes for his speakership, committing to move 12 appropriations bills individually. He hasn't done that. This deviates from the traditional approach of considering discretionary federal spending items issue by issue. Historically, Congress rarely meets its October 1st deadline for passing 12 spending bills, resorting to an omnibus bill or continuing resolutions. And what they do is they shove them all together with crap no one wants and say, well, if you don't vote for this, you're hurting the troops, you're hurting the old people on Social Security, you're hurting the poor on Medicaid, blah, blah, blah. I don't care about any of those people. Those people are sucking off the government teat, and that is going away sooner than later. So make your plans accordingly. But anyways, where are we? Gaetz and his conservative allies demanded a return to separate appropriations bills, resisting omnibus bills or CRs, continuing resolutions. McCarthy attempted to pass a CR, faced opposition from Gaetz, leading to a 45-day spending deal with House Democrats, a move that contributed to McCarthy's removal. The debate underscores the flaws in the current budgetary process, allowing for legislative mischief and inevitable growth in government spending. Gaetz's demand for adherence to the agreed procedural change is relatively modest. The federal debt's rapid increase, reaching over $33 trillion in just 3 months, highlights the urgency for substantial spending cuts. Ron Paul emphasizes the need to abolish the government's power to create money, considering it a critical step towards addressing the unsustainable economic trajectory. The standoff between McCarthy and Gaetz reflects the deeper issue in the fiscal responsibility of the government and the necessity for courageous decisions to prevent future economic pain or collapse. I mean, hey, so I'm actually cool with it. I know Ben Shapiro was mad. Boy, you would have thought Gaetz had stolen his yarmulke and tossed it into some, what did Jews not eat? Do Jews eat pork? Yeah, like he had rubbed it on bacon or something. They may eat pork. I don't know. Either way. All right. Well, that's everything I had for today. If anyone needs anything from me, feel free to go to dsafinancialgroup.com. On my contact information there. You can book a meeting, drop me a phone call, or send me an email, whatever you'd like. Or you can tell me to go to hell. I don't care either way. All right. Well, hope everyone has a wonderful evening, and I will talk to you guys next time.